The next thing that we look at in Chapter 6 is decentralization and segment reporting. So, a segment is any portion of an organization that we want to collect information about. This can be an individual store. So, when we think about, we have two Casey's in town. So, each Casey's would be an individual segment within the entirety of Casey's as a whole. We can also break down stores, department stores, or stores with lots of areas, such as like Target, Walmart. We can have a grocery segment and a clothing segment. The pharmacy would be its own area. We can also have a sales territory when we talk about segment reporting, where we might have a Northwest region or Southeast region. Companies can break down their segments any way that they want. When we break down income statements for segments, we use a contribution format because we separate fixed from variable costs. We have traceable fixed costs and common fixed costs that get involved as part of the segment contribution margin. And we're going to talk about each one of these costs separately. So first we have the traceable fixed costs. So traceable fixed costs are fixed costs that are unique to that particular segment. And if we closed that segment or location, that portion of the fixed cost would disappear. So some examples of fixed costs, traceable fixed costs. So we have the salary of the Fritos product manager at PepsiCo is a traceable fixed cost to the Fritos business segment of PepsiCo. And the maintenance costs for the building in which Boeing 747s are assembled is traceable to the 747 business segment of Boeing. So what costs are traceable to each section of the cost? Then we also have common fixed costs. Common fixed costs arise because of the overall operation for the company, and we would still have those common fixed costs if any particular segment was closed. Examples would be the cost of heating a grocery store or the cost of heating or cooling Walmart. If we separated Walmart into an electronics segment, a clothing segment, a grocery segment, the cost of the utilities benefits the entire store. So that would be a common fixed cost that would not be traced to individual divisions. Another common fixed cost is a salary of a CEO of a corporation. It's a common fixed cost. And can't be traceable to any specific division or location within the company. Traceable fixed costs can also be common fixed costs. And we'll look at an example where that happens. So this example says that the landing fee paid to land an airplane at an airport could be traceable to the particular flight, but it's not traceable to the first class, business class, and economy class passengers. Segment margin is the segment margin, what is left after we subtract traceable fixed costs from the segment contribution margin. This is the best number or gauge of the long run profitability of a segment. So if we're trying to decide if a segment is profitable and should be continued. So we're going to look at an example of a store with two divisions. We have a computer division and a television division. So we look at a segmented contribution margin format income statement. We have our variable expenses and our fixed expenses are separated. We use a contribution margin format for our income statement. We have our traceable fixed expense and our division margin. When we look at the television and the computer margin side by side, and then the company as a whole. So we have our division income and then our common expenses that result in the company's net operating income as a whole. So common fixed expenses should not be allocated to individual divisions because they are expenses we would keep even if one of the divisions were eliminated. Now we're going to break down the television division and look at how some of those traceable costs can become common fixed costs. So if we get back to our traceable fixed costs, we had $90,000 in traceable fixed costs to the television division. Of those $90,000 in costs, $80,000 can be traced to a regular screen, or $45,000 can be traced to a regular screen, and $35,000 can be traced to the big screen portions of the television division. The remaining $10,000 benefit the television division as a whole. Once we've prepared a contribution format segmented across, we can use that statement to make decisions and perform break-even analysis. Different decisions we can make are is every segment profitable? Are some segments not making money? And at which point would we decide that we're going to close one of those segments because they're not making money? We can look at break-even analysis. This is an example of decisional analysis. So we have, if we increase advertising for the television division, we see an increase in sales, which increases the margin and has a net increase on our divisional margin by $2,500. So those are the kind of decisions that we would look at. If we increase, we can even look at that further where we have the television and the computer department. So are we just advertising for the television division? Do we advertise as a whole? And how does that increasing sales 5% in the television division affect sales in the computer division? Because there are sometimes changes where if we push advertising to one division instead of as the company, we can increase sales in that division while actually decreasing sales in another division. And that's something else that we would have to look at if we were wanting to look at the impacts on the company as a whole. We can also look at break-even analysis for the company and for divisions as a whole. So we have traceable fixed costs of $170,000. And we have common expenses of $25,000. So when we look at the company break-even point, we would divide the sum of the company's traceable fixed expenses and common fixed expenses by the company's overall contribution margin ratio, which you remember the contribution margin ratio is contribution margin divided by sales. So this 270,000 divided by 500,000. So we get that the break even for the company as a whole is sales of $361,111. We can also calculate the break-even point for each business segment. So we have the contribution margin ratio and the break-even point in sales. So remember the contribution margin ratio is contribution margin divided by sales. And then for break-even, we take their traceable fixed cost divided by their contribution margin, and we get that the television division needs to make $180,000 in sales to break even, and the computer division needs a minimum of $133,333 in sales to break even. The cost that we assign to each segment should include all costs across the entire value chain that can be contributed to that segment. So the graph below shows all of the business functions that make up the value chain. So the value chain comprises everything from research and development to customer service after we've sold our product. This can include product design, manufacturing, marketing, sales, distribution, transportation logistics, customer service, returns, but any costs that are associated with any of these items. There are sometimes a lot of inappropriate methods of allocating costs among segments. We should absolutely trace any cost directly that we can. So costs that can be traced directly to specific segments shouldn't be allocated to other segments. And sometimes we use bad bases for allocating common costs to segments or traceable costs. So we should be allocating costs to segments only when the allocation base actually drives the cost being allocated. There are no rules about how costs get allocated out to different divisions or statements or segments. There are some basic mathematical methods that are more popular than others and are recommended. If you take cost accounting, we learn all of those methods in cost accounting about how to allocate costs to segments. Common costs shouldn't just be arbitrarily allocated. So we know that someone has to cover the common costs. However, if we use that rationale, we can make profitable business segments appear to be unprofitable. And it forces managers to be held accountable for costs that they cannot control. Some terminology, instead of calling them traceable costs and common costs, actually call them controllable costs and non-controllable costs. Because the traceable costs are the costs that the manager who is being, whose performance review is dependent on how their individual segment does, shouldn't be responsible for having to cover costs that he has no control in creating. So that's what that rationale is, that it's not okay to look at divisions and division managers based on things that they have no control over and evaluate their performance that way. With our company-wide income statements, so we first looked at variable costing and absorption costing. And as I've mentioned in class before, for the purpose of external reporting and our reporting, we are required under both US GAAP and IFRS, the International Financial Reporting Standards, to use absorption costing. Okay? Because absorption costing is required for external reporting, we generally also use that for our internal reporting. We just would use variable costing for various analysis instead of using it for internal reporting. We're also required to report segmented financial data in our annual reports. So any companies that are publicly traded on the stock market have to include both company-wide information and break out that information by segment. They have to report the same results using the same accounting methods that are used for internal segmented reporting. So we generally don't use the contribution margin approach for our reporting because then we would be required to also share this information in our annual reports. So we use the contribution margin approach just for analysis and decision making, but not for reporting purposes or records purposes. The same with variable and absorption costing. Because absorption is required under US GAAP and IFRS, we use that for all of our reporting, and we use variable costing for analysis and decision making. That is the end of chapter 6.